We think now that the market should be asking a slightly different question and a better question. Do traditional hard and soft market cycles exist anymore? Four factors hint that this market cycle has changed considerably and that maybe the traditional hard-soft market cycles shouldn't apply in the modern era. Firstly, capital is still available. Fundamentally, very little has changed since the banking crisis. Capital is not constrained and cannot therefore be said to be driving the cycle. Secondly, the rate increases have varied significantly by class of business. Some classes, like property cat, have taken an early lead in the hardening, whereas others are still expected to rise over the coming months. This is not the usual rising tide that you would expect from a hard market. Thirdly, the certainty around rate adequacy. For some lines of business, the market just doesn't know how and where is the rate that you should be penning at. CAT is a good example, despite being so widely written. With the evolving climate crisis, it will take time for underwriters to fully understand the implications on likely future losses and hence where can the rates be considered sufficient to cover the losses. Major CAT events have increased in frequency and geographic reach, driven by climate change. A study showed that the 2021 German floods was up to 9 times more likely to happen again due to climate change. And this is only about the period that I'm talking. We haven't even begun to scratch the surface of business interruption. And finally, the fourth one, what feels like the most compelling argument for this market being now different, data. Data, the new oil as they say. Other industries might argue that corporate and specialty insurance is not the leading edge in its use of technology and data. However, a huge amount has changed in insurance since the early 2000s. Data is much more readily accessible to even the most traditional of insurers. This gives insurers insights into performance at the class and the subclass level, with some insurers now diving down to the asset level within a policy for their analysis. Insights from data will only increase as the promise of the bionic underwriter becomes a reality. These four factors strongly suggest that things are different this time around. They indicate that possibly this hard market cycle is more of an amalgamation of small waves rather than an overall tide.
This insurance industry in India is at an inflection point. The pandemic disrupted economies. It also increased risk awareness. Just as India is pegged to maintain its rank as the fastest growing economy, the $126 billion Indian insurance market is growing at 13% and is assessed to rank as one of the fastest growing insurance markets in the next decade. And this is supported by regulatory reform, rapid transition to a digital economy, and the massive social sector programs supporting economically weak and the disadvantaged. I would highlight Ayushman Bharat, the world's largest health insurance scheme covering over 500 million people. At the IRDAI, we are more focused on our developmental role and have been in the last 9 months working in consultation with all stakeholders towards lowering entry barriers to trade and fostering ease of business. Our reforms, as well as the proposals currently being worked, are all in the public domain. The objective is to enhance the size and strength of the Indian insurance industry while making insurance available and affordable for all.
As we know, economic slowdown typically leads to lower demand for insurance, and high inflation will result in rising claim costs. We've already seen in construction, supply disruptions and labor shortages have led to an increase in repair and building costs. In motor, claim costs have risen due to shortage of parts. Liability will also be impacted with high inflation feeding through into bodily injury claims. And we have already seen the impact on global renewals on 1/1, where there has been a hardening of not just the rates, but also the terms and attachment points in many treaty renewals. However, in this doom and gloom, I would urge our reinsurer friends in India and abroad to look at us differently. Why, you may ask? Today, India is one of the fastest growing insurance markets in the world. In terms of total premium volumes, it was the 10th largest globally in 2021, with a combined premium figure of 127 billion USD, both life and non-life combined, and the second largest of all emerging markets. Based on expectations of strong economic growth, rising levels of disposable income, a young population, high digital penetration, and very dynamic regulatory developments, it is forecast that premiums will grow by an average annual rate of 12 to 14% per annum over the next decade. At this rate, India will be the sixth largest insurance market in the world by 2032, ahead of Germany, Canada, Italy, and South Korea. It is also expected that P&C insurance will lead, followed by health, motor, and agriculture. These sectors are expected to benefit from the Indian government's focus on infrastructure development, increased awareness of insurance products, and the introduction of new products. At 1%, non-life insurance penetration in India last year was significantly below the global average of 3.9%. Hence, there is immense scope for faster growth, which will be driven by demand for health covers as people are now more aware of health, and also strong support from government-sponsored mass health programs. The protection gap ranges from 35% to 95% across different lines of business. Hence, the government as well as regulator are giving utmost priority to formulate appropriate strategies to address this and close the protection gap.